How's everyone doing today? Hope we're doing great. Nice sunny day. Hopefully the rain is gone. We are very lucky to have two great speakers. Ryan, a first timer. Dan, many of you are familiar with. He's helped us with these economic updates in the past. Um, Thankfully, it's been a great year. I know it started out a little rocky, but what I love to talk about is as much as we rely on great managers, FIP now celebrating its 31st year has its own track record of managing our clients' investments through up and down markets, and helping them stay prudent through uncertain times and stay on track to their long-term goals, and obviously making adjustments along the way. Aligning with Dan and PIMCO and now Ryan is a big part of our success. And not only do they join us to talk to our clients, but we talk to them regularly along with other managers throughout the year to really keep our pulse on what's going on and be proactive about making changes if needed. Fortunately, we haven't had to make any big changes this year. As you guys know, our investment committee meets monthly. We bring in portfolio managers and economists to give us updates. And one of the things we're most proud about FIP's service model is all of our clients are in our allocation models. There's not specialty models for clients. So even though we don't talk to every client every single day, we are talking to clients every single day in the 40-60, in the 50-50, in the 60-40. And they are all consistent. So we are actually looking at these models every day, seeing how they're behaving, really being up to date on any possible changes. But I'm extremely proud of our investment philosophy and most importantly, how transparent it is to our clients. I love that you guys log online, look at your accounts and know what's going on, right? You understand it. You understand why we recommended it, why it's good for you, and why it should help you, for your long-term plans. So without further ado, uh, Ryan, I believe you're starting. So we are extremely lucky to have Ryan with us. So Ryan is part of Carson. One of the many reasons we joined Carson is because they're tremendous resources. And Ryan is one of the primary people on their investment team. And Ryan also helps us with our investment committee. Ryan has spoken many times, on CNBC and many networks. So without further ado, Ryan.
All righty. Well, thank you for that intro. An honor to be here. There's so much to talk about, but the truth is, it has been a pretty good year. So we'll just go with that. But it's an honor to be here. A huge fan of FIP and just looking forward to getting to know everybody and have a little fun here. I think I have like 45 minutes or so, so I'll just start talking and we'll just go from there. So let me see there's my slide. There we go. All right. We titled. By the way, I give a lot of these. This is the very first mid-year outlook that I've given so far, and I'll give a lot more over the next month or two. But we'll see how this goes. Kind of like riding a bike. I give a lot of presentations. But we entitled our outlook start of the year "Riding the Wave." The mid-year outlook is officially called Still Riding the Wave. I know it sounds kind of simple, but there are a lot of things out there, whether it be monetary policy, fiscal policy, the bull market, earnings, profit margins, AI spending, CapEx, all these different waves that are still out there, that in our opinion are still tailwinds. Now, when you ride a wave, I've never quite surfed, but it can be a little dangerous. You can wipe out. There can be problems like we just said. You know, software stocks crashed the first quarter of this year, really first 3-4 months or so. In general, like the Mag 7, the Magnificent Seven, large seven companies, I mean, at the midpoint of the year, those were down on the year. Yet small caps are up 20%, mid caps are up 15%, S&P 500 10%. Most global stock markets are up better than the US. So it's been a pretty good year, all things considered, even though we've had some rockiness, and that's what we're going to talk about today. So there's me at the beach, working on my tan. I've been with Carson. I got the alerts on LinkedIn 4 years. I just hit my 4 year. I think it's the 12th. On the 12th, I'll officially be here for 4 years. So chief market strategist, get to do lots of fun stuff. We manage billions of dollars. I'm a mouthpiece of the 15-person research team that we have here. I say a research team does two things: creates content and manages money. And I would put out our team has done those two things up really against anybody. I mean, 3.5 years ago, we were out there saying there'd be no recession and it'd be a new bull market. Trust me, it's obvious now. But in 2023, we got a lot of weird looks and a lot of confusion as to how we could say that when everybody else was saying something different. We look at the world. I'm going to explain how we look at the world here, but we're still pretty optimistic in how we see things happening out there. Now, I like to use stories. I like to use stories. So there was a terrible fire in Yellowstone National Park in 1988. You might remember it. You can go read about it. And at the time, it was just devastating. This gorgeous park was just devastated. There was certain trees and parts of the park that were never going to come back. And when your head hit the pillow that night, or hearing about it, it was terrible. Now, the interesting thing about that, though, is now most people agree that the park is better than it's ever been. And a lot of that is because of that devastating fire. That fire went through and took out brush, took out parts of things that had stopped growing. And then what happened, it cleared it out and allowed new growth and allowed new parts of the park to grow. And as terrible as it was actually necessary to make Yellowstone better. And I think that's a lot like bull markets, and that's a lot like the stock market, because just the last couple of years, what's happened, right? Well, we had a 34% bear market in 6 weeks, 6 years ago with COVID. Market rally 2021. Then 2022 had a 25% bear market from the beginning of January to the end of October, or to October 2022. 2023 had the regional bank crisis in March, a lot of worry and fear. August 2024, we had the yen carry trade unwind, which caused a lot of worry and fear as well. Last year, we had a near bear market. When I say bear market, that stock's down 20%. Just know it's probably, you look at your statement, you're not feeling too good. That's just how it goes. A near bear market around Liberation Day and tariffs, right? That happened last year. Then this year, of course, the war. The war came out of nowhere. Crude oil doubled overnight. That is a 6 standard deviation event. Ladies and gentlemen, that's supposed to happen once every 4.1 million years. It happened a couple months ago, right? So what we're sharing here, again, the chart of fears, we're not minimizing those things on there, and a lot of those caused big drops and problems with the economy. But what we are saying is, on the longer term, stock markets tend to go higher. And we're not just blindly saying that. Believe me, we're active managers. We look at different things. We want to talk about why we still are positive, why we've been positive for several years, even though it was not very popular with what a lot of other people were saying. Now, a quick story on the 7-year itch. You've heard of the 7-year itch. 7 years in a relationship, a job, a car, whatever it is. Our brains are wired to kind of get tired of things. They want something new. It's not our fault. It's how we're wired. 100 years ago, something called the Roaring Twenties. Stock market going crazy. Washing machines, cars, electricity, telephones, airplanes were coming. Lots of cool stuff was taking place 100 years ago right now in the Roaring Twenties. 1929 had a major peak. Stock market crashed 86% into 1932 in the Great Depression. Then the World War II happened, and a funny thing, World War II actually in a lot of ways kind of kickstarted our economy in a lot of ways. And then once that war was over, by 1950, we made new highs on the S&P 500 for the first time since 1929, or at least on the Dow. Add 7, and what do you get? 1957. 1957 was a 7-year itch after new highs were made in 1950. The 7-year itch, we saw a bear market and a recession in 1957. But Mark Twain said history repeats itself. History doesn't repeat itself, but it often rhymes. Mark Twain. For 11 more years, that secular bull market, stocks went higher until 1968. Pretty major peak in 68. A lot of people might remember the 1970s or heard about it. High inflation, low productivity, oil soared, vicious recession, high unemployment. Not a great time for investors. 70s was not a great time for investors. Funny thing happened in 1980. The stock market finally broke out to new highs. Add 7, and what do you get? The 7-year itch took place 1987, October 19th, 1987, down 20.4% in one day. a day in October 87. 87 crash. That's a vicious 7-year itch. But then the stock market rallied for another 13 years into 2000. Major, major peak. The bubble, tech bubble burst, the accounting scandals, 9/11 eventually happened. All that stuff happened. We had a 3-year vicious bear market. Stocks were cut in half. Then we rallied a little bit more to 2007. We made a new high for a day or two. And then the great financial crisis, another 50% market correction or market bear market. That's called a secular bull market. Everyone from 2000 to 2013, the S&P 500 literally went nowhere. That's a secular bear. As rough as that was, that opened up the door for the new secular bull market we have been in since 2013. We broke out the new highs in 2013. Add 7, and what do you get? 2020. 34% bear market, 100-year pandemic. But then what's happened since? We've been going up. We've been doing pretty well for 6 years. These secular bull markets last a lot longer than you think. The honest truth, if you're in a secular bull market, you need to benefit from it. We have been in one for a long time. We've been talking about these concepts for a long time. Doesn't mean every year is going to go up. Doesn't mean every year is going to be perfect. In fact, there's no such thing as a perfect year. But the truth, again, is this secular bull is alive and well. Probably has many more years left to it, is my personal opinion. But for investors out there, at least for the remainder of this year, these waves are real, and the 7-year itch is real. It happened. It's happened before. It'll happen again someday. But the stock market tends to go higher for many, many years after the 7-year itch. All right. So with that high level stuff out of the way, we just had our 250th birthday in our country, July 250 years, which is awesome. And I didn't realize this, but I saw this. So the UK, they spell certain things certain ways, US. So why is it canceled with 2 L's in the UK, but canceled with 1 L in the US? Because we gave them that L in 1776. There you go. Happy 250 to everybody out there if you had a good July 4th holiday. So there's a lot of ways we can take this conversation. We've been overweight equities for years now, saying you want to be in stocks. It doesn't mean we go all in on stocks. I mean, you go all in on technology. It doesn't mean you go all in anything. We're diversified. These are geeky words we use, but we stay diversified. Overweight equities, but have a diversification around it. These, all you need to know, or look at the colors. These are different sectors in certain years, what leads, what lags. If something's the best performing sector for a year or two, you know what's going to probably happen? Might be the worst. Vice versa. If it's the worst, it might be the best. I mentioned small caps. Small caps are up 22% the first half of this year. I probably can say this with a lot of certainty, unless you're talking to a small cap manager. There weren't a lot of people banging the drum 6 months ago to say, go all in on small caps. We have small cap exposure. We have mid cap exposure. We have large cap exposure. Now we kind of do tilts and different things. But the reality is it's important to remember, when in doubt, diversify it out is something we've been saying for a while. And that's a good way to show it. So what do we see at the start of this year? And again, this is kind of cool. This is literally the first time I've ever shared this with anybody publicly. So I'm excited to get to do this today. At the start of the year, we said the S&P 500 gained between 12 and 15%, and bonds would do between 3 and 5. In late March, when we had the 9.1% peak to trough correction, the war was raging, oil was soaring, the strait was closed, all the uncertainty going on, stocks were going down, a lot of worry out there. We kept our target of about 15% if things go right. When you look up and you're down 5% for the year, 15%'s really, really far away. And we hung tough, and we kept that there, and we laid out why. If you like some of the concepts and things I'm talking about, be honored. I've got a podcast called Facts versus Feelings. Talk about all this stuff. If you can check that out, I'd be honored. But Sonu Varghese on our team is a guy I work very closely with, our macro strategist. A lot of the charts I'm sharing came from Sonu as well. But we said we still thought stocks would do well. And a lot of well-known bulls were cutting their targets, going all over TV, talking about how bearish everything was. And I said, oh my goodness, if he's now bearish, if she's now bearish, you know what? The last bull has waved the white flag. We just had the greatest second quarter rally in the history of the stock market during a midterm year, up almost 15%. All right. We've had an incredible rally off those late March lows. Now we have upped our target to between 15 and 18% on the S&P 500. At the time we're doing this, S&P's up maybe. I think we're down a little bit today. Stock market's been a busy morning, but we're up about 10, 11% on the year. So we're still pretty optimistic. It's still going to be a pretty good second half of the year as we continue to ride the wave of this bull market. So we'll talk about the economy and policy for a couple minutes. First, very important to ask the question, why did God create economists? To make the weathermen look good. The honest truth. Weathermen, they've got a rough job. It's not easy. But economists, we've had economists for years. If you turn on TV and watch it, talk about how bad everything is and how this is going to bring the end of this and this is going to this and this. Yet the market is up 105% since the start of 2023. Now, I guess when I say the market, that's the S&P 500, but most things are doing well. Oh, by the way, the Dow, the big one. I know a lot of investors and clients pay attention to the Dow, rightfully so. It closed above 53,000 yesterday for the first time in history. Dow started trading on May 26th, 1896. We've had wars, inflation, deflation, recessions, assassinations, all this terrible stuff. But the market has gone higher eventually every single time after all those bad things that have happened. You know why? Because a lot of good stuff also happens. Good news travels really slowly. Bad news, especially in today's world with social media, travels really quickly. We know all the bad stuff that's happening all over the world, and I'm not minimizing it, but all the good stuff that's happening tends to kind of be ignored a lot because it just is there. But as investors, we need to remember that. So again, a lot of economists have not had the best track record. I would put what Sonu has been saying out there up against anybody, laying out why the economy would avoid a recession the last several years. And I'm going to go this one first. We think the economy could heat up the second half of this year. This is our proprietary leading economic indicator. Sonu puts this together as about 40 different inputs in there. Again, leading indicator. All you need to know is this leading indicator of ours, the Carson, I guess we call it the Carson Investment Research proprietary leading economic indicator. It never said there was going to be a recession in 23 and 24 when so many people were telling us there's going to be a recession, even after Liberation Day. Go back and look at what people were saying 15 months ago, 16 months ago. It was going to be a recession. Tariffs going to cause massive inflation. All this stuff was going to come to a screeching halt. Remember they were telling us last summer there's nothing going to be on the shelves. And that's what people were telling us. It was out there. None of that happened. This thing has accurately shown what the economy might do, and it still is saying the economy is starting to heat up in the U.S. Now, what's so unique about where we are now is there's something called soft data and hard data. Soft data is how you feel. Hard data is what you're doing. We've been seeing this for years. Consumer confidence is near some of the lowest levels ever. You ask people, how do they feel? People apparently don't feel very good. But then in the next breath, you see things like retail sales, how many people are traveling, how many people are going to hotels, Open Door, DoorDash, all this stuff does all these different data pieces that show consumers are just fine. Just last week, we saw consumptions running at 6.9% the last 2 quarters. Consumers are still spending. Consumers are still doing things. So they feel one way, but they do another. Someone who travels the entire country, I can tell you, every time you go to the steakhouse on a random Tuesday night, no matter what city you're in, it is packed, right? I mean, so the economy to us is not perfect. There's cracks out there. There's issues. The housing market is truly an issue. Higher interest rates are hurting people still. But the reality is the economy to us, there's no recession coming. Okay. I mean, you look at the wedding that Taylor Swift just had in New York City. My goodness gracious. I mean, there's a lot of money being spent out there. All right. So let's see here. So inflation, though, is still a problem. We were one of the few shops, I think, at the start of this year. They were saying inflation could broaden out. Inflation might be a little bit more of a problem. But you know what? We called it an inflationary growth environment. We thought inflation was going to run 3.5% this year, but the economy is going to do pretty well. And that's exactly what we're seeing, what we expect to continue to see. So, one thing about inflation, with what happened with the oil prices, oil was round tripped though. So oil went all the way up, it doubled, it's come all the way back. So there is higher inflation out there due to energy prices and the strait being closed and the war and everything. But we're starting to see some major improvements there. But here's one that's actually real world. And you probably heard about this one. Apple just a week ago, or maybe 2 weeks ago, upped their prices significantly 20, 30, 25%, 15% across the board, all the different Apple products that everybody knows and loves. That's because of the AI memory chip shortage. On the left, you can see here, it is what it is. The South Korea, here's this fun stat you might not know. The first half of the year, the South Korean stock market was up 105%. That's one stock market up 105%, mainly because of just two companies, Samsung and SK Hynix. They're two big companies that continue to grow, and they make all these memory chips. That as the AI rollout and AI build out continues to grow much faster than even some of the most optimistic bulls thought, people are gobbling up these chips. Semiconductor stocks have had an incredible first half of the year. Now, they've kind of weakened a little bit lately. I'm not shocked by that. That's a stretched rubber band. The good news, money's rotating. We'll talk more about that in a second. But inflation is still a little bit of an issue. Now, we can skip that one. The reality is with the Fed, we have a new Fed. We have new leadership at the Fed. There's Kevin Warsh, and he's kind of said that he's been known as a hawk in his past life, meaning he's going to be more likely to hike interest rates to get the job. I think he kind of said, I'll be more of a dove, to play the game. But that's the Fed's statement that just came out. You can see on the right how much it changed. There is a new sheriff in town as it pertains to Kevin Warsh. The reality, though, is, oops, I went the wrong way. Okay, I guess no, we'll talk about it. The market is looking for potential rate hikes the second half of this year. All right, there's like an 85% chance, give or take, there will be a hike by October. Again, to hike interest rates, potentially to slow down inflation and slow things down a little bit. We don't think that's going to happen. We think the Fed is on pause. Again, as you look at things like shelter and other parts of inflation, it's starting to come back, and energy prices starting to come back. So those are some things that are net positives in our view. But the Fed is still on pause here. If the economy continues to get stronger, the labor market continues to improve, and I think I've got a labor market slide coming up next, which we think it will. These are all still net positives. We've called things like running it hot. We think the Fed's going to run it hot as a steward of assets. It manages billions of dollars. It works for financial advisors every single day. Our job is to look at this and do the best we can to correctly call how we see things. And we still think the Fed, if the Fed doesn't hike right now, but the market's expecting it, that's more dovish than being priced in. In our opinion, that's going to be an overall positive. Now, I will say, let me try to read this little joke. I got to go put my reading glasses on. An increase in interest rates by the Federal Reserve today sent the stock market down. But then the hope that this would lead to sustainable economic growth moved the market back up until the realization of higher interest rates would stall the recovery, sent it back down before it ultimately rose, and expectations of a sluggish economy would cause the Federal Reserve to lower interest rates. That's a fun cartoon that's like 30 years old that literally you're going to listen to yesterday. Okay. I mean, this is a classic. It's not easy. We understand that, but that's a fun cartoon that sums up some of the confusion. What doesn't, or what really, though, is driving this bull market, in our opinion, is earnings and profit margins. You see here, we call these the dual tailwinds. This bull market for 3 years, we've been talking about these two things. There's war, there's inflation, there's the Fed, there's Washington drama. There's lots of stuff going on out there that a lot of people are confused. How in the world is the stock market hitting all-time highs with all this crazy stuff happening? We would argue it is earnings and profit margins that continue to move higher. Earnings season starts up next week. We'll see how that goes. We're optimistic once again, we have a solid earnings season. It'll justify kind of where we are. Another thing, I don't want to be too geeky with this. There's something called price to earnings multiples, PE multiples. All you need to know, the stock market is cheaper now than it was at the start of the year. So the stock market's up 10% this year. Yet stocks are cheaper now than they were at the beginning of the year. That's because earnings are going up significantly faster than the overall S&P 500, which in our opinion is a good thing. I mean, they say the stock market's the only place that things go on sale and everyone runs out of the store screaming. Would you buy your favorite shoes or a jacket or a coat or whatever if it's on sale? You probably would. When it comes to the stock market, the way our brains work, that's not how we work, right? You might say, I want to buy XYZ stock if it drops 10%. You know what happens when it drops 10%? Your brain goes back to caveman times, and it's time to huddle up because we care about our money, we care about our family, we care about our religion, right? Those three things, and our sports teams a little bit. Those things matter a lot. And plans are useless. Planning is everything. President Eisenhower, I love that quote. Plan for volatility, plan for these things. That way, when it happens, because it's going to happen, I mean, every single year has some crazy headline that nobody saw coming and causes market volatility. It'll happen again. I bet the next couple months we have some crazy headlines ahead of this election, and we're midterm elections. We're probably going to have a pullback of maybe about 5 to 8%. Perfectly normal, nothing out of the ordinary, especially after the rally that we've had. But just some things to think about. But you can always come back to how earnings and profit margins are doing, and they continue to justify this bull market. I won't spend a ton of time on this, but the labor market is really turning a corner and improving. We were talking about a better labor market started this year. Just so everyone knows, all of last year, our economy made 120,000 jobs all year. The last 3 months, we've averaged 110,000 jobs created. We're seeing unemployment rates still at 4.3%. We're seeing a participation rate still fairly high. Overall, one of our bigger kind of contrarian calls the second half of this year is a better labor market. We know AI is a big part of the economy. We know AI is a big part of GDP. That's a gross domestic product, how our economy is doing. The consumer is so. I wouldn't call them weak, but by no means would I call the consumer strong. If the labor market continues to improve like we think it can, that's another big positive on the economic front. Riding the wave with AI, it is what it is. These big hyperscalers are spending incredible amounts of money. It is just the building these big super factories and manufacturing big factories and all these things. You can see on the right there, kind of these big names, Microsoft, Alphabet, that's Google, Amazon, Meta, and Oracle, just how much they continue to spend. And you know what? Earnings season is coming up in a couple weeks. We're going to update these again. And we think this wave is going to continue. But I want to be very clear here. Technology stocks are up like 30% for the year at the start of this year. I'm sorry, at the middle of the year, That's an incredible move, right? But what we're starting to see, I wouldn't be shocked at all if technology takes a little bit of a break. I mean, it is what it is, right? The lifeblood of a bull market is rotation. All of a sudden, we're seeing things like industrials, things like healthcare, things like financials that are really starting to do well. And again, there's nothing wrong with owning technology. We're slightly overweight technology in the billions of dollars that we run. But we think, that baton might get passed around from technology over here to other cyclicals over here, like financials and industrials. And that's a good sign, perfectly normal. But again, there's still a big wave when it comes to this. Talk about politics just for a few minutes. Will Rogers, I don't make jokes. I watch the government and report the facts. So I get asked all the time, who's better for the stock market, Republicans or Democrats? Now, listen, I'm going to say something. If you don't like the answer, I'm going to offend the other half of the room next. I'm going to try to offend everybody. That way, everybody's happy. Technically, the stock market has done better under Democrats and Republicans longer term. But if you look at how the stock market's broken down, it actually does much better when Republicans control both chambers of Congress. And you could argue you get more done when you control both chambers of Congress than when you have the Democrats control both chambers of Congress. But I'll just put it like this. Do not mix politics with investing. I mean, I've done this a long time. People didn't like President Obama. Stock market did amazing for 8 years, right? Didn't like President Trump 1.0. Stock market did really well. Didn't like President Biden. Didn't do so well one of those years. 3 of those years did really well. Don't like President Trump again 2.0. How's stock market doing? Doing pretty well. So again, don't mix these things. Like I say, it's not about red, not about blue. It's about green at the end of the day. So that's stuff to think about. Now, also, here we go. A split can be good. So the reality is right now, the Republicans have the Senate and the House, and they have the smallest majority in the House in 140 years. Do not shoot the messenger on this, please. It's just the facts. The last 23 midterm elections, the party that lost the presidential election is the motivated party, right? They gained seats 20 of the past 23 elections by an average of 29 seats. The Republicans have like a 4-seat majority, 5-seat majority. It's very likely that the Democrats take back the House. But as of right now, there's a good chance Republicans keep the Senate, right? They have a 53-seat majority with a fairly easy map, all things considered. Anything can happen. I get it. But a split Congress, everyone, is probably the best scenario. What we're showing here on the left, the last 13 years, we had a split Congress, the stock market went up. I don't think that's a coincidence because if you have some big red wave or some blue wave, you know what happens? All this spending to get everybody happy that just won, but it doesn't help the whole country. And a lot of times you probably shouldn't be spending that money anyway. So now there's checks and balances. A country that needs to pass anything has to really work together to get anything done. Or you could argue maybe gridlock can be good too. But the reality is, if we have a split Congress when all is said and done in November, that could be a real net positive. But I'm going to end it with this. My friend Sam Stovall said it this way. If the opposite of pro is con, then the opposite of progress must be Congress. There you go. All right. So we'll talk about equities for a little bit and wrap this up. So is this business as usual? I mean, this is fascinating to me. I looked at the previous 5 years under President Trump, smushed all those years together. Check out what happens. That's the black line. You tend to have weakness in February, March, into early April, a major low. Everyone goes on TV, tells you how bad it is. All these analysts start cutting their targets. Everybody gets all bared up, and then the market rallies like crazy. That sound familiar? You know, it's amazing how this worked. Again, Mark Twain, history doesn't repeat itself, but often rhymes. Just kind of be aware of this. And no, we don't blindly invest just because of this. In fact, we don't. But I just think it's neat to tell a story that this is a fairly normal. President Trump sometimes does things a little more aggressive, a little more out of the box, a little more the market didn't see coming early in a year. Sound familiar with what we've seen the last couple of years with Liberation Day and the war? And then things kind of calm down and you get past it and you rally from there. I mean, it kind of one of those, it is what it is. So this year looks somewhat familiar from that point of view. The average year gains about 9% on the S&P 500. This is fascinating, though. Only 4 times in history, and I guess it's that gold color, has the market gained between 8 and 10%, about an average year. So average is not so average when it comes to investing. It's real important to remember this. 22 times the market gained 20% for the year. 21 times it was down. So the odds of an up 20% year are higher than a down year. That's fascinating, but that's what it is, right? And it reminds me of this whole joke. This statistician, he put his head in a bucket of ice and his feet in the oven. They said, "How do you feel?" He goes, "You know, on average, I feel pretty good." Yeah, I know. There you go. But just kind of remember these concepts that, and where are we right now? We're up 10% right now. We're up 10% right now. So could we really finish flat-ish from here? I mean, sure, we could. But only 4 times going back 76 years have we done something like that. So this is another reason we think the market probably continues to work its way higher before the end of this year. But it happens, everyone. Stocks fell sharply today because that's what stocks do sometimes, right? Um, it happens, and it fascinates me how everyone gets so worked up when the market pulls back 5%. The market pulls back 10%. Most years, this happens. Volatility is the toll we pay to invest. It's something we say a lot at the Carson team. It's just important to remember this, that every year is going to have some bad stuff. What's the movie called? Lawrence of Arabia got a famous scene called the candlestick scene. There's this candlestick, and the guy walks up to the candle and pinches it out. Second guy sees it and goes, "I want to try that." Walks up to the candlestick, pinches it out, screams in pain. He looks at the first guy and he goes, "How in the world did you just do that?" First guy looks at him and goes, "You just got to know it's going to hurt." That's investing. It's going to hurt. April of last year, and we're down almost 20%. Tariffs are going crazy. The markets are all confused what's going on. That hurt a lot. End of March, when we had a 9% pullback in the S&P 500 and oil's going up and the war is raging and no one knows what's going on, that hurt. Every year is going to have moments like that. And again, I want to be stress this. We're probably going to have another hurt moment ahead of this election. Midterm years tend to have volatility, especially ahead of the election. Once you get past the election, that's a good thing. I got some slides come up on that. But that's just stuff to remember. Regis Philbin said the stock market's fun and sometimes very painful. Again, the toll we pay to invest is volatility, all right? Once a year, on average, you'll see a 3% dip 7 times, 5% mild correction 3 times a year. On average, you have a 10% pullback once a year. Doesn't mean every year has to have it. Some years have more, some years have less. That's an average. But just know that this is what happens most years. Momentum begets momentum. We just had one of the greatest 2-month rallies in the history of the stock market, up 19.5% in 2 months. You can see there. What happens next? The returns across the board are extremely strong going out 1 year. Those are just some things I think about. Now, something that just happened recently, we don't have the chart on this. We were down in the first quarter in the S&P 500. We were up 15% in the second quarter. Previous times, everyone, a negative first quarter and the second quarter is up 10%. You know what happens? The rest of the year has never been lower. 41 times the stock market gained at least 10% for the quarter. That next quarter, so the next quarter, which would be right now, was higher 85% of the time. Momentum is real. That washout we had earlier this year and now the strength the second quarter all again suggests this wave of strength being led by maybe a more dovish Fed, being led by maybe better inflation, being led by strong earnings, being led by profit margins, are all reasons to think momentum's alive and well. Chart from my friend Tom Lee. If you ever watch CNBC, Tom's on there. He's probably on there right now for all I know. But Tom pointed out that markets bottom. This is obvious now, but markets bottom way before the conflict is over. Tom look at World War One, Two, Korea War. Look at how quickly the stock market bottoms way before the conflict is ever over. And that happened again, right? I mean, last I checked, we're still over in the Middle East. There's still issues going on. The strait is not fully open. I know it's kind of open, fully open. I mean, listen, this isn't over yet. The market's looking past it. I mean, the Dow's hitting the highest level it's ever trading at. Small caps, highest levels are trading at. Global markets, highest levels are trading at. S&P 500 is about 1% away. Hey, I think we're going to get there. I think this bull market's still alive and well. But just remember this, that the news might be terrible, but the market is a forward-looking mechanism and looks forward. We'll skip that one. I don't need to get moving here. Midterm years have the largest peak to trough correction, 17.5%. Off of those lows, though, the market's never been higher. What is it? 31.7% on average. I get it. Here's the catch. Nobody knows when the peak to trough max correction will be on the S&P 500 during a midterm year. I do think it probably was the 9.1% peak to trough correction we saw late April. We're like 20 or so percent off of the late March, off of the late March lows. So the average is 32%, right? So we could have a little bit more left in the tank going forward is how we see that. Slingshots. I actually just gave an example of a slingshot with the negative first quarter, then up 10% second quarter. But here are previous slingshots looking at last year, right? We were down more than 15% for the year last April around Liberation Day. Yet the stock market came back to gain 10%. 1, 2, 3 other times in history have we seen that. Small sample size, yes, but check out what the next year did. Every time up double digits with some really strong returns. Here we are once again up 10% or so this year, and this slingshot that we just saw last year and the one we just saw in the first, second quarter are real and can continue. Year 4 of a bull market. This bull market started when the bear market ended. The bear market ended October 12th, 2022. 25% bear market, not a good time for investors. It is what it is. It happens. But one thing we've been talking about is year 4 of a bull market's usually really strong. You can see it here on the screen, right? What's year 3 do? Kind of choppy, kind of frustrating. That sound familiar? Yeah. Year 4 tends to be a really strong bull market, and that's another thing that we're thinking about as we go forward. Now, age is just a number. This is John Cena, famous wrestler, just retired. Now he does movies, and that's the brother from Hannah Montana. This was taken, I think, in 2008 or 9, somewhere around there. This is a famous image because they are the same age. I think they're both 31 years old in this image, I believe is what it is. Pretty incredible, right? Age is just a number, which brings us to this bull market, a big theme we've talked about for a long time now. This bull market's younger than you think. This bull market just cracked 3.5 years old. If you look back in history at other bull markets that made it to their third birthday, a third birthday is kind of that magic number because we've seen some that made it that flashed and burned in like 1 year, 2 years. But once a bull market gets to its third birthday, it's a little more mature. Check it out. They continue to go. Looking at the last 5 bull markets that made it this far, going back 50 years, the average length is 8 years. The shortest is 5 years. The reality is this bull market, could it end with a 100-year pandemic or something crazy? Absolutely. Something can always happen like this. But absent that, this bull market very well could have a lot longer left than most people think. And this is a concept we've been talking about for a while. So this bull market might have turned 3 back in October. They usually get the 4. And again, looking at history, They tend to last a lot longer, so that's a positive thing. Midterm years, I already talked about it, but historically they aren't all that great for investors. The good news, this is President Trump's 6th year. I guess it's good or bad news, depends if you like the guy or not. But the reality is President Trump's 6th year, right? It's his second term. This is a concept we've talked a lot about, and I get it. It's not 6 years in a row. I understand that, but it is what it is. So put an asterisk next to it if you want. But check out the returns during the 6th year of previous presidents going back, what is it, 70 or 80 years? Yeah, 6 years usually pretty good. Small sample size, I will admit. But again, here we are in the 6th year of President Trump, and stocks are rhyming with history, to paraphrase Mark Twain. Abe Lincoln, it's not me, it's not me who can't keep a secret. It's the people I tell who can't. Love that quote by Abe. Couple more things and we'll wrap it up. And I know we've got Q&A in a little bit, so I have a doctor's appointment with my daughter, so I'm actually, when I'm done, I'm going to jump off and drive, and I will do the Q&A from my car, so that should be just fine. I don't see any issues why that shouldn't work. But here's a couple common questions I get, so I am just going to go now. I hear all the time the U.S. is top heavy. Oh my goodness, these 7 stocks are this, these 10 stocks are that. The 10 largest stocks in the S&P 500, I'm sorry, in the United States. In the United States are about 40% of the overall market cap. That's what the media tell you all the time. Oh my goodness, these top 10 stocks. You know what's happened though the last couple of years? Because those top 10 stocks are a lot. They've gone up and the market went up, right? So if that's all you use was a top heavy market, a reason to be bearish, you've missed out on huge gains. But the other factor, look at this. Only Japan and India are not as top heavy as the U.S. Looking at 25 largest developed markets, so it is what it is. U.S. isn't as top heavy. Now, this might hurt a little bit to some of you. I'm more indifferent. Check out the most top heavy country out of all of them, Belgium. Apparently, I didn't slow down their soccer team last night, did it? So Belgium, and again, they're a small country, which makes you sick that you just lost 4-1 to a small country last night. But we'll leave it there, everybody. I don't like talking about too much sports when it comes to this stuff. But the U.S. is not as top heavy as many people think, especially when you look around the globe. The other one, the U.S. dollar and debt and all this stuff. I hear all the time the U.S. dollar's losing reserve currency status, losing reserve currency. The dollar's been strong this year. No one's talking about it. Dollar's been strong this year. During COVID, March of 2020, what happened? U.S. economy shut down. Gold crashed, bonds crashed, and the stock market crashed. Go look it up. All of them were selling off. You know what went up March of 2020, right in the beginning when everything went bad? The dollar, the cleanest shirt in the dirty laundry. Listen, if you think currency wars are new, there have been currency wars as long as there have been currencies. Of course, China and Russia and the BRICS and some of these other countries, kind of not our best friends, let's put it that way. Of course, they want to knock the world's reserve currency down. Sure, they do. We're not seeing it. You can see here just Swift data. People are still using the dollar. All right. I think March of 2020 was a good reminder that when the what hits the fan, people flock to the dollar. Now, here's the last comment on this. If the dollar is really strong, you know what that means? It probably means the market's not doing that well. I actually don't mind a little bit of a weak dollar. Historically, a weak dollar has been more of a risk-on asset, a risk-on sign that the market is healthy and stocks are doing well. If the dollar starts to soar, well, hey, maybe we have the world's reserve currency, but it probably means, be careful what you wish for, because it probably means everyone's off buying the U.S. dollar for the safety that it provides, and risk assets, specifically stocks, probably aren't doing all that well. But here's how it works. As someone who works in the financial industry and the media a lot, the pilot has indicated we're going to experience a little turbulence. Fasten your seatbelts. We're going to die. That's just a financial reporter. That's their job, everyone. Listen, I go on CNBC all the time. I'm a CNBC contributor. I'll be in New York City on Thursday, running around New York. I'll be on, I think it's Power Lunch. I'm pretty sure I'm on Power Lunch on Thursday morning. I'm sorry, Thursday afternoon from New York. And now that you know me, if you ever watch CNBC, I'm on there often. But the reality is they have a job. Media has a job to get you to click on it, to get a reaction. Our job as investors, I'm not saying to ignore it, but just know that's how the game is played when it comes to the financial media. That's why you're in very, very good shape, right? With where we are and what we're doing and working with the team we work with and all the stuff that's going on because we follow the fundamentals and we follow this stuff. Of course, we follow the media because we know that's what you're hearing. We know you're the clients. What are you hearing out there? My job is to understand what TV is talking about and then push back or agree with what's happening out there. But just know that's how things work. Check on sentiment. I think sentiment's still negative. If everybody's thinking alike, somebody isn't thinking. General pattern. There's a lot of negativity back in late March. We saw opportunity. Sure enough, we rallied. I mean, the one on the upper right, oh, poor George Washington kind of hung over at the bar there. Doesn't look very happy, right? That's the sentiment that we continue to see. But then I travel the country and I see people and I go places and meet people. People are in a good mood. So I can't wrap my fingers around it necessarily, but bull markets are supposed to be fun. You're supposed to be enjoying what's going on. Most people don't. Just last week, we saw huge drops in various put to call ratios I'm sorry, bull bear ratios and surveys and things on what was normal kind of late June volatility sell off. Nothing to be too worked up about, in my opinion, but being bullish isn't popular. And those magazine covers from The Economist, I mean, talk about over the top. When you see stuff like that, you know what tends to happen? Market tends to rally. And yeah, we just had literally one of the, I think the fifth greatest second quarter rally ever, best midterm second quarter ever after those rather bombastic, if you will, magazine covers. Just a couple more. I am almost done. So my doctor, I've been working with my doctor. He said I need to start eating healthy, losing weight. I'm down like 30 pounds since November. So it's a bear market around here, which is good. But my doctor said I need to start eating more fish. And I travel a lot. And I found a restaurant that had this type of fish. It was absolutely wonderful. I don't know if you guys like fish like that, but I would highly, highly recommend eating more fish like that. So what's our advantage as investors? There's hedge funds, there's algorithms, there's AI, all this stuff. Our advantage as investors is time. It's not timing the market, it's time in the market. Every random day is up 53% of the time. Every week's up 57% of the time. Month, 60%. Every 5 years, 80%. I call this the rule of Joe Montana. Remember Joe Montana, famous quarterback, number 16? Every 16 years, stock market's always been higher. Now, we do not want you to buy something and wait 16 years to make your money back. I want to be very clear. But let the hedge funds, let the algorithms, let the computers pick up nickels ahead of the steamroller. We know going in, these are our advantages. This is our advantage as investors. Again, the stock market's the only place that things go on sale. Everyone runs out of the store screaming. You can buy stocks anytime, but just imagine you buy them when they're down 20% and think the long term, next 5 years. You're probably going to have substantial gains. And I know it feels uncomfortable. I do this for a living too, and I've done this a long time. And when the market's having bad days and it's red and everybody's worked up about it, it's very, very uncomfortable. But that's why you're in very good hands working with the team to have these plans in place ahead of time to expect volatility, but to know these big picture things can continue to help you. The biggest coincidence in the universe, I think, is this. The moon is 400 times smaller than the sun, but the sun is 400 times further away than the moon is to the earth. And when you have those two things, you can have an eclipse, which is a pretty amazing thing when you think about it. And it reminds me of this old story. There's this old guy with his grandson on his knee, and the grandson looks up at grandpa and he goes, "Hey, Pa, what's an eclipse?" Old guy looks down at him and goes, "No, son." That one usually takes a second or two to get. That's my eclipse joke. So listen, there's coincidences out there. There's not. Um, I think the fact that we're all here right now, is not a coincidence. The fact we get to do this together. The fact this is my very first mid-year outlook that I'm going to do. I'm going to do a lot of them. This is the very first one. There's a lot of things that are happening out there that we're lucky, right? Like if you're on this call, you're probably pretty darn fortunate. There's something called a K-shaped economy. I've gone long enough. I'm about to wrap it up here. But a K-shaped economy, part of the economy is going up, part of the economy is going down. It's true. It's happening. But if you've invested in the stock market the last couple of decades, if you've owned houses the last couple of decades, if you've done, gold, commodity, lots of stuff, even bonds, lots of things have made people a lot of money the last several decades. But specifically, you owned a house, you own real estate, and you own some stocks in the stock market, and you've invested the whole time and didn't make too many bad. We all make bad decisions. I make a ton of them, trust me. But you've invested for the long run here. In all likelihood, your net wealth is about as high as it's ever been. And that's something to be grateful for. But without our health, none of this stuff matters. So hopefully everyone has continues to enjoy this bull market, continues to stay healthy and just benefit from what we have, and still a wave of likely a continued higher trending equity bull market and global bull market. So I do need to show the disclosures because everybody loves disclosures. Yeah. So with all of that, I'll stop sharing. This is when I always say, I hope everyone still hears me and I hope everyone's still there. Yep. Looks like you are. Well, I don't know, Jared, do you want to jump in or who's jumping in? But this was an honor to get
Yeah.
to do this. Thank you so much. I'm a fan and hopefully everyone enjoyed that.
Yeah, Ryan, we really appreciate it. And what I love that you do for your presentation, because we've been running economic forecasts for at least 10 years and we've had a lot of different speakers, CFAs, and sometimes they're just talking over everyone's head. And when we book
Yeah.
people, we're like, we want great material, but we want everyone to understand it. And just like Dan does, you did such an amazing job of adding so much value and information, but really keeping it so digestible for everybody.
Good.
So you really did an unbelievable job. I'm gonna let
Love
Dan
it.
go, but real quick, everybody on Zoom, if you hover your mouse over the screen, there will be icons at the bottom. In the bottom icons, there's a circle with three dots that's more, and one of the options is Q&A. That is where you can type in your questions that we will be holding until the end of the session. Courtney will help facilitate with that. Um, Ryan, I know our attendees uh, aren't, this isn't live, but I can assure you everyone's giving you a round of applause. We really appreciate your
Awesome.
contribution and insight.
Love it.
And now, as everybody knows, a regular at FIP, PIMCO has been an amazing partner with us for many years with our bond strategy and continues to perform really well and be a great partner with us. Dan Miller.
Thank you so much, everyone. Can you guys see my slide ahead of the curve?
Yeah,
Yes, we
we
can,
see it
Dan.
perfect.
Perfect, perfect. So just want to say thank you to Ryan, even though he might have ducked off. I've been a big fan of his for years, been following him for many years, and Carson is a tremendous investor in PIMCO. So things align and couldn't agree more with a lot of what he said. But today we're going to just focus what we call ahead of the curve and talking a little bit about more focused on the bonds because Ryan did a fabulous job talking about, equities, the economy, and views. So we'll focus this a little bit more on fixed income. Um, Obviously, FIP has been a great partner for decades for PIMCO and myself, and really pleased to be back here for the umpteenth time. I really do enjoy this as always. So with that being said, fixed income, there's three main reasons why you want to invest in fixed income. And as I know and all you know, with FIP, it's always about your financial plan, right? The roadmap, the plan, sending in your postcards on vacation. But you need diversification in your fixed income. So you want it for income and returns, right? Bonds can provide that to investors. Diversification, right? Everything Ryan just talked about, the equity markets, there's like fixed income, but there's good times, there's bad times. You stay the course, but bonds truly act as a diversifier. In theory, if equities and your riskier assets are struggling, you hope that the bonds are there to soften the blow, to ride out the volatility and can act as a diversifier. And of course, preservation. Chances are it's not guaranteed, but in most cases, barring default, you're going to get your investment back in fixed income. So whether that's a 60/40, 30/70, 80/20, that's why you work with the team at FIP to decide on your allocation. So with that being said, if one of you was so generous on January 9th, my birthday, 1977, which when I was born, gave me $1 million, I would have done well in cash. I would have outpaced inflation. However, core bonds would have done a lot better, right? More than double you would have done in just being in core bonds. So I'm not the best at math, but I know I'm turning 50 this January. So with that being said, roughly 50 years, your $1 million just in a safe investment, core bonds, you would have been worth roughly 19.7 million. So core bonds, compounding, things like that, very safe asset class in general. You would have done very well. And with that being said, just talking about some sort of volatility, core bonds are roughly have a standard deviation somewhere around 5.5%. The S&P is roughly 15.5%. So roughly a third of the volatility of equity. Um, as Ryan mentioned, right, ups and downs. There's some time periods, years where things hurt. It hurts. 2022 was that year in fixed income. Bonds were down, as you mentioned. Equities were down. Everything was pretty much down. But the good news is the band-aids were ripped off, right? It hurt. But bonds, fixed income reset, and yields went up tremendously. So, as you've heard me say, yields and price kind of work inversely. So if yields go up, typically in fixed income, prices go down. With that being said, we all know in 2022 that happened. It was painful. Yields reset. And this is showing you the checkered part is where yields sat in different asset classes and fixed income at the end of the year of 2021, but where they sit March of 2026. Yields have gone up tremendously. 22 was pretty much the year where you felt it all in your NAV or your price. But since then, having a higher yield is extremely beneficial for a fixed income investor. So we got to the other side. Why is yield so important? Well, it's roughly your starting yield is roughly correlated 94% to your 5-year return, or your forward 5-year return. So essentially, what that's saying, well, obviously there's no guarantees, but essentially what that's saying is whatever your yield is today, you can hopefully anticipate that's what you're going to get every year for 5 years. So if something's yielding you roughly 4.5%, you would anticipate roughly getting 4.5 every year for 5 years. Once again, no guarantees, things can happen. But it's a 94% correlation. So it's a pretty good marker to show you what you got. Since 2000, your average yield since 2000, around 2010 was 2.8%, but now we're sitting at 4.6. So once again, higher yields are very attractive for fixed income investors. Fixed income returns have delivered very attractive yields. Even Ryan, his last comments there, he said, no matter what you've owned in that K-shaped economy, if you have financial assets, even bonds, you've done well. Well, looking at this chart since September 23 to March of 26, we'll have this updated obviously very soon, but fixed income has done well. If you look at the different categories, you've beaten cash pretty much in all categories, right? And this is why you want to be extremely diversified. Once again, it was mentioned earlier, diversification does well in fixed income, but diversification does extremely well in fixed income as well, because you never know what asset class is going to do well. You want to be extremely diversified. As I know your models at FIP, they're extremely diversified in what products that FIP uses with PIMCO, those products are diversified. So diversification helps. Here's another chart, which I always like to show. When the Barclays Ag is yielding between 4 and 5%, and we're right there right now, and we've been there for the last bunch of years, we're roughly at 4.3, 4.4%. The yellow bar here is the average starting yield. The average return is the blue circle, the dark blue circle. So what it's kind of showing you is, once again, starting yield is a great indication of your future return. It's not perfect, but it's very close. So your average return has been very close to that gray line, which is your starting yield. Once again, 1 year, 3 year, 5 year, and 10 year. It's a pretty good indicator of your fixed income returns what your starting yield is. This is just showing 12 months before a rate begins to cut or hike, cash outperforms. However, we are in agreement with what Ryan had said and what Carson, I guess, believes is we don't believe the Fed is going to move right now. We think they're on hold through the end of the year. The market still thinks there's hikes. We believe the Fed's most likely on hold here through the end of the year. So many fixed income sectors have outperformed following rate cuts. Once again, there's cuts, there's hikes over time, different things happen. Um, as you can see, 1 year prior to a cut, you've done okay and done pretty well actually in fixed income. But 3 years post a cut, fixed income has done very well. And once again, as rates go down, it's beneficial for fixed income. Usually yields go down, prices go up. Once again, no guarantee, but you can see fixed income has done well 3 years post cuts. And we're right around that now. Bonds historically, once again, outperform cash. So, people tend to feel like they need more cash. Once again, if you have your monies with FIP, it's invested. But truthfully, most people are sitting on some sort of cash or maybe possibly too much cash elsewhere. And it's always, good to put it to work. Sure, you need that emergency money, whether that's a year, 6 months, 3 months, that's what you decide with FIP. But with that being said, no matter what the rate cycle is, historical rate cycles, whether it's the pink line, the current cycle is the yellow line, emergency cuts if the Fed has to cut rates quickly. We're showing you here to the right what different fixed income areas or sectors have done. So if higher for longer, which is maybe the case, the Fed's on hold, fixed income did well. Immediate cuts, you've done better. Once again, that relationship between price and yield, you've done very well. And then, emergency cuts are typically, something's going on in the economy, what have you, but you still did well. And I would show you the gray being cash, all these sectors, no matter what the situation, are doing better than just sitting in cash. And these are, once again, just fixed income. This is just talking about the municipal market. So we've seen this diversification chart. Ryan showed one for stocks. We're showing you here one for different countries. And the reason being is it's a global world in fixed income. And as you can see, the US market here in the dark blue, it's $59 trillion. It's big, but it's only 37% of the whole entire global fixed income market. So if you only owned US, you're going to only own a smaller, not even 40% of the overall market. So once again, EM, emerging markets, is a big part. Developed markets, not US and the Eurozone, and then the Eurozone. Now, you don't have to say, oh my God, I need to go buy that. PIMCO and the products, we're doing that for you. I'm sure some of the models have things like that as well. So once again, you're probably getting it without even realizing it. Once again, as Ryan showed on his chart, one area or one sector of fixed income stocks, or even countries, if you just want to follow, any color here, if you follow purple, okay, it was down here, but then it was higher, then it was lower and higher. And, if you look at green, that's the same thing. So even countries perform differently. And the key to things is diversification, which, the other speaker talked about. Um, During equity drawdowns, bonds have delivered positive returns, and this goes back to diversification and doing well. Once again, we're not here to say that equity drawdowns are coming or anything like that, but they do happen, and recessions happen. So on the left here, we're showing you non-recessionary drawdowns when equities were down 17.5%, bonds were up slightly, but they were up. In a recession, you would think, and which this shows, in a recession, equities would even draw down further, which they do. But bonds, and once again, we're showing you treasuries here as our proxy, we're up even more. Once again, as my first slide showed you, you're in this for diversification, to diversify, to hedge, and things like that. Current valuation bonds deliver attractive outcomes relative to stock. So this is looking at one form of valuations. And then this is showing you that bonds look very attractive versus one form or one way to evaluate how equities look today. And once again, this is when yields are between 4 and 6%, which they currently are. And when we say yields, just looking at the Barclays Ag. So the cost of misbehavior can be meaningfully over time. Partner with a trusted advisor. Right? The investor return is less than the blue here. So in this time frame, the investment, whatever it was, returned 8.2%. However, the investor only experienced a 7% return. Why? Because the top of this, the behavioral gap. And Ryan alluded to it earlier, right? When things are on sale in the financial markets, people are afraid to buy, they get nervous, and unfortunately, the end investor sometimes does the wrong thing. They panic, they get out at the wrong time, and they might experience a loss even though their investment was up. Well, that's why you want to work with a team like FIP because they're there to guide you, to talk to you, to explain to you what's going on, why not to panic, why maybe you should buy why things are down, and to right the ship, to keep you in the investment. Once again, a growth of $1 million over 40 years, and this is meaningful. Right here, you're talking about a 1.2% difference in return. You might say, okay, 1.2%, what's that? Well, when you look at it in dollar amounts over 40 years, look at the difference in price for the person that is working with a financial advisor and staying the course versus maybe the investor that only experienced a 7% return versus 8.2. In dollars, it's a tremendous amount of difference. Bonds are different when it comes to active versus passive. Um, the active manager 91% over a 10-year time beat the passive manager. It's a little bit different in large cap or equity. It's harder to beat in an active world, but in fixed income, it's a really big difference. And there's a few reasons why it's different. Um, Indexing in equity is a little bit different or very different than fixed income. So just for an example, if essentially you wanted to buy the S&P 500, you could buy 500 names, you could weight them, and there's only 500 names, and you buy them. Well, in the Barclays Ag, or what most would say is the equivalent to, let's say, the S&P on the fixed income world, the benchmark that everyone uses, there are 10,000 offerings. So they just can do something called sampling. They don't own the individual per se, every bond. You can't because there's thousands and thousands of bonds to own. There's many different bond participants, many different coupons and things like that. So you can't just sample. So in fixed income, you absolutely want to be active. Um, with that being said, this is just an illustration. An equity investor on the right here, there's essentially one security in that equity. If you wanted to own whatever the name of that company is, whether it's GE, Microsoft, or whatever, there's one equity to own. Well, in fixed income, there's many different options to own of that same organization or company. And that's what this is showing. So I think with that, I'm going to leave it there to keep on track with time. I think we're probably going to turn it back over to Jared, and I'm thinking we're going to probably go with a Q&A.
Yeah, thanks, Dan. Again, as always, great job. We love bringing in two different experts from two companies to ideally give us two different perspectives. But I like when both perspectives are positive, so that's really good for all of us. Before we jump into Q&A, Just want to touch on a couple of things that we do at FIP for our client experience that you guys, um, that's been your service model for now over 31 years. The first thing we do, and of course it's so important to invest the money correctly, but what we do is we know there's up and down markets. So all of our clients have a financial plan. Of course, they're my FIP, one of the top financial planning softwares in the country. And we always run that average return at only 4 or 5% because we know there's going to be market volatility. So we love to give our clients confidence. Hey, at these reasonable rates of return, ideally you are more than on track to your goals, or we're showing you what you need to do to be on track. And then of course we give access to your year to date and since inception return. So when there is volatility, you can say, hey, my since inception return still at 5 or well above 5 or close, and I'm okay. Our job is to help give you guys confidence, whether the market's up or down, that you're on track to your goals. And that's just one way that we do that. The behavioral finance aspect that both Ryan and Dan touched on is something that we, implement really well. The average advisor adds 2 to 3% net return to the clients that they work with. And then if you guys recall, when COVID hit, we didn't call making drastic changes. Back in 2022, when there was significant volatility, we're not jumping around making all these, big changes. We know how to hold the course. We're extremely confident in our investment philosophy and how we build our models, and of course, how closely we watch it. So just by us being really prudent investors, aligning ourselves with the best managers and a diversified group of managers, we really have confidence through up and down markets to continue to do the best thing for our clients. And ideally, because of that, compliance might be on the line, not guaranteed, but get you better returns. So just a couple things I wanted to touch on, what makes me really proud about our firm as a whole and also our investment philosophy. So is there any Courtney, I don't know if anybody got to enter questions.
I don't think we have any that have come through. If anyone does want to take the time to type any in now, or you can click the raise your hand button and I can allow you to speak if you do have any, and that's quicker.
Well, Courtney, can you hear me? I'm in my car this time. Do you hear me?
We hear
We
you
can hear
great.
you.
All right. Well, I'll just go ahead if that's all right, because I know a common one is U.S. debt, and I didn't really talk about it. So I'll say this, and if anyone has any questions, type it in. But our country obviously has, trillions and trillions of dollars of debt, and every time we look, we have more and more debt. And I'm not crazy about it. You're not crazy about it. I mean, this question always comes up, and I do tend to save it because I know it's going to come. The reality, though, is I call this denominator blindness because, yes, we have $31 trillion worth of debt, but we also have an incredible amount of equity, right? So you have to consider that. Like we look at households debt to equity ratios. And yes, we have trillions of dollars of household debt that's out there as well. But people are actually, in terms of a balance sheet, in better shape now than they've been in the last 25 years. And it is similar to kind of the last concept I talked about, where the top end of the economy is doing better. Clearly, the bottom end is struggling, but the bottom end has always struggled. The good news, if you look at like the middle, you hear all the time, the shrinking middle class. Well, it is shrinking. There's less people in the middle class now. You know why? If you look at this data, the data's out there because more people are going to the upper middle class because they have been investing, because they have had real estate. There's less people in poverty now than there's ever been in the history of the United States, and even globally for that matter, more literate people now. So things aren't perfect, but it's there, and I'll leave it with this little story. The dollar used to be pegged to gold, right? The dollar used to be pegged to dollars worth a dollar because gold, it was pegged to gold. Well, now a dollar's worth a dollar because we say it's worth a dollar. There was a time when we severed the dollar from gold in like 1972 or 73 is when we did that. And John Connally, Treasury Secretary to Nixon, a room full of bankers, they said, okay, the dollar's no longer worth anything, or not, I shouldn't say that. The dollar's no longer pegged to gold anymore. That infuriated central bankers all around the globe when the U.S. did that. A lot of people say it caused a lot of the big inflation we had in the 70s. I don't know. I mean, it very well could have been some of the reason. But John Connolly told a room full of bankers, it's our currency, but it's your problem. And that's been the U.S. attitude of debt ever since. As I talked about a little bit ago, we do have the world's reserve currency. When you have the world's reserve currency, can you play by a different set of rules? I mean, maybe you can. Maybe you can. And the reality again is that's what we have. We have a strong currency still. We have the world's reserve currency. We have a lot of debt also, but we do have a lot of equity, and you have to consider the equity factor as well.
Sure.
Hopefully you heard me and that made sense.
Yeah, I have a question. We've had some clients ask about an AI bubble. I'm sure that's something you guys get asked about a lot. So Ryan or Dan, are both of your inputs about what you guys feel about this concern?
I mean, Dan, you can go first. Feel free.
Sure, thanks, and welcome back, Ron. You missed all my good accolades to you. Saying I was a big fan of yours for many years, and Carson's a great client of PIMCO and everything like that.
Thank you.
But with that being said, so there's going to be winners and losers in AI, right? Like anything, but AI is for real. It's absolutely for real. As Ryan mentioned, there's gazillions of dollars being spent on it, but it's for real. The software companies, equity-wise, had a bit of a struggle of late, but it's something real. It's going to make companies, people more productive. It's an absolute real thing. It's as they say, bigger than the stock market or what have you. Excuse me, the internet. With that being said, is there certain dollars chasing certain things? Yes. But once again, we'd say you need to be with active managers that know what part of AI to invest in and what parts not to.
Yeah, great stuff there. So I'll build on that. We don't think it's a bubble. Now, listen, you're talking to an equities guy. So, you can talk to somebody else, but I get a different opinion. Here's the truth. These companies are making a lot of money. These hyperscalers, we're going to hear about it. Could they be ahead of themselves? And I talked earlier, semiconductors are up like well over a couple 100% over the last year. South Korea stock market's up 105%. I mean, there are parts of this market that feel frothy. Let's just be honest about it. But the truth, again, there was a guy. I've talked about a lot of presidents, Fed presidents. A guy named Alan Greenspan. He unfortunately passed away, but he made it to 100 years. He was in charge of the Fed for 18 years. And he gave a very famous speech called the Irrational Exuberance Speech. A lot of people have been talking about this since he passed away. And he said on December 5th, 1996, he gave reasons why there was irrational exuberance, implying some of the stocks that were out there, the high-flying names, were getting a little pricey. And he was right. They were. But you know what happened? The S&P 500 doubled the next 3 years, and the NASDAQ was up 300%. This is one of the smartest people in the world with more information than anybody, giving little clues, little nuggets that things were getting a little ahead of themselves. A lot of people listened to it, and they would have missed out on historic gains. So what we're doing at Carson Group, the money we run, we absolutely are still overweight technology. We still think AI is alive and well. But we haven't diversified. We're not going 100% all into these AI tech names. We have some healthcare, have some financials, have some small caps, have some industrials, have some low volatility stocks where we'll still benefit from the wave of AI that we don't think is over yet. But it's all about what's something priced and what's something worth, right? And again, some of these companies are ahead of themselves. We didn't talk about SpaceX IPO, limited what I can say about it. But, the reality, you look at these big IPOs we've had the last 20 years, you know what tends to happen? Stocks usually underperform the first 3 years after an IPO. I'm not saying that SpaceX is a bad company. I'm not saying that at all. I'm just saying that that's kind of how this stuff works, and it's good to be aware of that. But again, to still benefit from this overall global bull market is real. I mean, this company, last comment, like Singapore. Singapore is a huge country that's very influential. Singapore's stock market just this year broke out above levels it was trading at in 2007. All right, going like nowhere. U.S. fortunately has done really well, but there are countries that are just now breaking out. So we think there's a lot of opportunity around the globe that you can still benefit from AI, but still benefit from this overall structural bull market that we're in.
Yeah, one other thing I would say that PIMCO has been saying is, as a country, you need ideally AI and energy. The US has both. China has AI, they don't have energy, and Europe pretty much, depending on where, but most of Europe has neither. And that's troublesome, certainly like Germany and things like that. So, US is in a very good situation here. Once again, politics aside, but we have AI, we have energy, and we have a lot going for it.
Awesome, perfect. So we'll wrap up with just maybe one more quick question. But as we review with all of our clients who are still on, just our investment models average has about 12 different positions based on your risk tolerance and time horizon. But looking at one of the models, just because you have 12 different positions, that's 2,500 different stocks and 12,000 different bonds. So we don't have over concentration in any one stock. We most importantly keep that diversified, and again, diversify management styles. As much as I love Carson and as much I love PIMCO and all these other, you don't have a whole portfolio of the same things. So what great news, we actually do have two questions. One from a client. Courtney, please read the client's question.
You can allow Arnie to talk so he can ask it himself. So Arnie, if you want to unmute really quick and go ahead and ask your question.
Can you hear
Arnie,
me?
welcome. All the way
Well,
from California.
everything's fine here, a little bit better than in Philly. I have a couple of questions, but the first one is, since you were talking about AI, let's talk about ETFs and your models, because you've obviously changed models when we went to Carson. And the question is, and most of the ETFs, or they passively run or actively run? Because I know that you were talking about other mutual funds, and Dan was talking about them, and one always not in the ETF world seems to do better than the other. What is happening in the ETF world, which is different than what we had before, and how does that affect what you all choose for FIP and your
Sure.
clients?
So I'm best to answer that because I'm most familiar with the models. So the ETF, well, so the bonds are all still actively managed. So it's the
Right.
equities,
Right.
correct? So
We're not talking about the bonds though, but yes.
the equities have a mix. And I can go one by one, but there's a mix. Some of them are completely passive, might get rebalanced once a year. Some are semi-passive, meaning they get rebalanced twice a year. And then some are active ETFs, which mean they're actively getting traded, but because of an ETF structure, those capital gains still aren't flowing through like a mutual fund. So it's a mixture of the strategy. So we loved and still could sit here and tell you how wonderful our old mutual fund strategy was, because we've had amazing funds, amazing active managers, and still a great net return. Why we moved to ETFs? Well, right away for our non-retirement plans, it made considerably more sense to be in positions that were more tax favorable for our clients. But also considering that ETFs have lower expenses, we're always looking for ways to save our clients money. Now, we wouldn't say, oh, well, we're going to move to ETFs just because we saved the clients money. ETFs have now been around for, and Ryan and Dan, correct me if I'm wrong, 10 or 15, and some even 20 years. And most of the ETF strategies reflect the mutual fund strategy. So we felt that if we can get the possibility, past performance isn't indicative of future results, similar performance, if not possibly better at a lower cost, with all the due diligence of understanding how they're going to be run, that would be in the best interest of our clients. And also, as many of you have noticed this year, our new ETF models have done unbelievable net of the investment you guys make into our firm, and not only on the market recovery, which many of you are outperforming the individual benchmark of the allocation you're taking, but when the market was down, that 4 or 5%, and you were doing your reviews, you most likely were under the allocation of the risk you were taking as well. So Arnie, did that cover the question, or is there a follow-up to that, or did I miss anything?
No. It partly does that, but it's interesting because if you go ahead and then take a look at the ETFs and you take the index funds that have been around even further or earlier than the ETFs, I think, if you had a good index fund, you didn't probably fall if you invested properly. You probably didn't do that bad relative to what the ETFs are doing, and you'd be very close to whatever you were paying in terms of, for the company doing that. In other words, your expense ratio wasn't that far along from the index fund, or am I wrong?
The new ETFs or the old
No,
mutual?
no. If you take a look at the ETFs and you take a look at good indexed funds that have performed well, the expense ratio probably has not been extraordinarily different between the two. Is that correct?
From our old mutual fund model to the new model, it is different. From generalized ETFs to our current ETFs, probably not very different, if that's the comparison we're making.
Well, in the old days, in terms of what you all had, a lot of your funds were not indexed funds, if I'm not mistaken, in your
Correct.
model.
So moving to the ETFs,
That, right,
we cut the expenses in
right.
half.
Yeah, okay. Here's another quick question, and both Dan and Ryan may look at this differently. When most of your clients are probably on the older rather than the younger side, is there a time when you might need to go ahead? When should you start thinking of maybe having more of a conservative portfolio than obviously the ones that are higher risk?
So, Ryan, if you guys, I mean, I could also address Arnie. Who'd you like to address that, Ryan and
Well,
Dan?
they're looking at it differently. That's why I
That's
like both
okay.
of
Yeah.
their
So
opinions.
Ryan or Dan.
Well, I'll be quick because I know every client's different. I mean, that's the easy answer I'll give on that. I will say, I heard, Pennsylvania. My daughter's going to go to Penn State in 2 months, so she's a freshman. So that's your guys' part of
Congratulations.
the world, right? So yeah, we're in Cincinnati. So anyway, okay. So with that, I guess it's always this age-old question: if you think you're still in a secular bull market like we do, um, you know, if you miss out on some of these gains, if you made a lot of money, right, Arnie, you made a lot of money, but are you
That's
saving the
correct.
money for
That's
the next
correct.
generation? Are you trying to make money for the next generation? So that's the big question. But fortunately, the team at IFP will help explain that better than I can.
Dan, you wanna just your
Yeah,
input?
I mean, so first things first, Ryan. My daughter just finished her freshman year at Penn State, so feel free to
Wow,
reach out. But with that being said,
all world.
that's really not what I do. That's where FIP would help you out. To be honest, Arnie, regarding like
Right.
typically people say as you get older, right, you take on a little bit less risk, but everyone's situation's different and what their financial plan and what their goals are. So I really would not comment to be.
Okay, understand.
And briefly, because I had this with a client the other day, that's the beauty of working with a financial advisor, wealth strategist, is we're not just calling to look at one of your investment accounts and talk about performance and returns. We understand your personality, your family's needs, your short-term goals, your long-term goals, your legacy goals. And on an account by account basis, we can really sit and say, hey, based on all your assets, based what your risk tolerance is, based on the time horizon, and also based on a withdrawal rate, here's how we can meticulously kind of organize each account, which is not only best for you, but most comfortable for you. Because I do have clients, hey, their plan looks great. And they say, I am more risk tolerant. And maybe we will reduce that based on how they feel, not based on how confident an advisor at FIP is in the economy, based on what's going to be best for the client and also make sense with their financial plan. So those questions, you'll work with your advisor to really kind of do a deeper dive on. But Arnie, really appreciate really great questions.
All right, we did just receive one more question, and it is, how does China's control of rare minerals affect the US and the rest of the world in terms of the AI race? I don't know who wants to
Well,
tackle that first,
yeah,
but
that's a,
don't, I'll
that's
jump
that's
at
a
once.
yeah, that's a tough one there. Obviously, China did some things last year where they were. I mean, like I'm literally in a car, right? So like to move the seat, you need these rare earth minerals, which are big magnets. That's when you move your seat, it's actually a big magnet in there, and that comes from China. So that is all part of this. I mean, you could argue, and listen, don't shoot the messenger here, on the whole reason we're doing with Iran is we're trying to do this because it's trying to impact China. There is a lot going on there. I mean, China is clearly our enemy. It is what it is. They do control these. Now, the other thing is we have some of these rare earths and rare things. It's just, there's a reason. They're dirty, right? They're dangerous to get. There's not a lot of people that want to get these, and that's why we have to go to China. But one of the things about what our country is doing, we're trying to do a lot of this stuff on our own anymore. So now, how quickly will we get to literally a fire truck going by me right now? Didn't see that coming. Anyway, with that, we're still at their mercy is the short answer, but we can impact obviously things back with tariffs, different things. So hopefully we reach a calmer spot. But the truth is they've got leverage they can pull on us, but we have leverage we can pull on them, and that's kind of the world we're living in right now.
Dan, anything on that or?
No, I don't have anything to add there. We would agree.
Courtney, is that any other questions? Well,
Nope,
I want
that
to
was all we had.
start by thanking our speakers. I know you can't hear, but I'm sure you're getting a big round of applause. You both did excellent. Shout out to Courtney, who sets up not only this event, but all of our memorable experiences. I think the overall, as my dad likes to say, thumbs up or thumbs down, it sounds like a thumbs up. Most importantly, we're going to continue to be by each of your sides throughout the year and the rest of your life to give you ongoing confidence that you're on track to your goals. And of course, we're still looking to grow the business with families like yourself. So if there's anybody that we can help, not only with great financial planning, but these really awesome events that we run, please make sure to have them reach out. And everybody continue have a safe and fun summer.